Okay, I want to start out and I'm going to talk a little bit about the expected Fed pause, really from here for a while. So we'll begin there. Then I'll go through my usual things on kind of the economic calendar for the past week, the upcoming week, and then also the investor sentiment. And then I'm going to end with, and it may be a little bit lengthy, but I put chapters in, talking about where I think we are in the market cycle. So that's what I'm going to do today. So let's start, and let's just start with this article from CNN Business. And it says the Fed probably won't cut rates anytime soon. Why that's good news for the markets? Well, in essence, what first of all, I think it's like a 90% plus chance that the Fed's not going to raise rates anymore, for the time being, anyway. And they have already stated that they do not want to cut rates anytime soon. And Arthur Burns, who's was the Fed chair before Volcker, that led the rates to go. He increased the federal funds rate and then he immediately cut it, and inflation went crazy. And Volcker came in, did his thing to get the rates back down. And number one, we can't do what Volcker did back in the late '70s, early '80s, because we have too much debt in the U.S. $31.6.7 trillion, and back when Volcker was the Fed chair, it had I think a little under $1 trillion in debt at that time. So, and which was a big number back then. I remember hitting trillion was like, ooh, that's something big. But now we got 31.67 trillion. So anyway, in this article, and in essence goes with what I believe is we'll see the pause, but we won't see a cut. So we aren't going to get any more increases in the federal funds rate, but we aren't going to see a cut either. We'll see this pause. And, it's really kind of bad news if they start cutting right away, because that means that there's a crisis happening, whether it's in the banks there's a number of different points of failure for cutting rates. So that's the expectation. And this raises the opportunity for the markets to go up. And this is that kind of, I've talked about this pendulum, and I think we're at the bottom now of this pendulum before things start swinging the other way, when they start to cut rates. And, the Fed doesn't want to, and I don't think they're going to increase them anymore. I think they were too hasty in the increases that they had. But the expectation is that we'll be in a long pause, and this will create an atmosphere for stocks to go up. Now, this isn't a trading call. I'm just giving you my opinion, and this article supports that. And you can listen to any of a number of other places, and they're going to tell you something different, and that's fine too. So you just kind of have to take it in. But I think if we get this pause, then we'll be able to see the markets be a little bit freer in its movement upward. So that's what I wanted to cover there. Now let's take a look at this last week. And, there wasn't a lot of action, nothing really on Monday. On Tuesday, we had this economic optimism thing, and it, went way back down to 41.6. So, this is much lower than what they would have than what you would expect. The consensus was 48.2, and the previous was 47.4. So that kind of set a negative tone to the markets at the beginning of the week. And, we also saw on Wednesday, we saw the mortgage rates go down. But let's be honest, what was significant in the economic calendar was the CPI. And it came in pretty much in line, maybe a little bit lower, but, it didn't like explode or go down in a big way. And then the PPI, which was down 0.4% the previous month, which is, I think, a kind of an anomaly. But the consensus was 0.3%, and the actual was 0.2%. And, you would have expected maybe something a little bit more positive out of the markets. There was some initial enthusiasm, but initial jobless claims came out larger. So I don't know. Just right now, there's just this, we might say complacency, and we'll talk about that a little bit later in the market cycles portion at the end. But Friday, consumer sentiment finally started to drop in a significant way. So we're 57.7. Kind of peaked out here, and we're headed back down. Now nothing ever goes down in a straight line, but there's some weakening in the consumer and what their sentiment is about our economy. Taking a look at this coming week, we can see that we have, the New York manufacturing. Keep an eye on that. Manufacturing will ultimately be huge in this country, because I think we'll have to be forced, in essence, for a combination of reasons, both economic and for military reasons, doing more manufacturing in the States. And we have a long way to go. We've lost all the tool and die makers and things that when I first got out of college, we had a lot of those skills, and now they're gone. And so those are going to have to be rebuilt, and they're not rebuilt overnight. We'll take a look at retail sales, be something significant. Going back to kind of the housing thing and the mortgage, our expectation on a 30-year mortgage, probably about the same, unless something changes Monday and Tuesday. Building permits, expected to be 1.43 million. We'll see what that comes in at. Then there's a month-over-month figure. Then there's housing starts, which have been decreasing. And then we have, again, on Thursday, initial jobless claims. And we also have the Philadelphia Fed Manufacturing Index, existing home sales. So there's some things that could move the market there. But, the most significant thing will probably be on Friday, whenever the Fed Chairman Powell speaks, tends to move a market because either people overread or underread what he's saying. So it's always an interesting game. So that's what to look for next week. And if we look at the markets this week, these are ones that I trade. We're looking at the Dow Jones Industrial Average ETF, DIA, and this is a weekly chart. And we back tested kind of this downtrend that I had. There's nothing magical about it. Maybe we're in a box. There's a number of things we do, but I kind of had drawn a downtrend here, and we seem to be back testing it. The candles are interesting to me because if you could see the long wicks at the bottom, that usually indicates that they're fighting back, except Friday was, this past week especially, they're all long tails. And so that's good because, they're trying to push the market down. The bears are, and the bulls are coming back in, fighting it back up. And then SPY, kind of been in this box for a while. If we go back, we'll take a look at the weekly, but still these longer wicks, which again means that the bulls or the bears have tried to push it down. The bears came back and pushed it back towards the top, but really not a ton of movement. But they're not bad candles. I mean, they look like something that could move forward. We got NASDAQ with the triple Qs. We kind of broke out of this. It's still in its uptrend, um, mo- moving up, and again, weekly data. And then the DXY actually a little bit more concerning. We had this bullish engulfing candle here, covers really the last almost 4 weeks of data, with one weekly candle that large. So is, will this go back up and we hit up in this area here? We'll have to see. Obviously, that affects then the markets. If the dollar goes up, typically the market will make its way down, and then also the 10-year rates, started down, got pushed back up. We almost have like a little doji from the week before. So there's not a ton of movement on that. Your expectation is you'd like to see this thing go down. I know David Hunter's thinking 3.9% could happen. If that does, the markets are probably going to go down in the short term. And then we had crude, which continues to kind of slowly but surely make its way down. Some expectation is that as economic activity continues to decline, this will go down in the low 60s. And then the VIX, which it keeps trying to make its way back up over 20, but look at that. I mean, it got pushed up over 20, which, that usually it not only increases volatility in the market, tends to increase volatility in the market. It's not 100%, but typically the market's making its way down. And this last week, it obviously tried to go up, got pushed back down. This week, kind of just stayed in the area, wound up down just a fraction. So that's kind of a look at the markets. The investor sentiment, and let me also, I want to put let's get the fear and greed index up there too. But the investor sentiment, it inched down a little less bearish after Thursday and Friday. I think that this has probably made its way back up somewhere probably close to this 44.9 number. But again, this comes out on Wednesday night. And then, we had a few more people move into the bullish camp. I'm guessing some of those have moved out or maybe moved to neutral. So, we'll take a look at it next week. But, it also depends what happens Monday and Tuesday and Wednesday before the next release of this. Now, fear and greed index, it's updated daily. And, it's hung in there. Actually, Thursday and Friday, this thing started to go down. We had a little push towards the end on the markets that pushed it back up into the greed portion. But, I think sentiment begins to change with regards to the Fed pausing. This thing can run. And so that's what I want to lead into for this kind of last section. And let me kind of get these up and running. There's a lot of conversation about market cycles right now. And so when I look at these, let's take a look at these individual market trends. And you see basically the market's been on this uptrend. We had this COVID thing back in 2020. We made our way back up. We're back down this kind of bear market channel here. Now we've kind of made up and just kind of just swimming sideways at the moment. So that gives you a look at where we are at the moment. And if we take a look at the bull market cycle, well, let's take a look at, that'll work actually. You can see there's a couple different ones that I've pulled off here. Okay, so in the bull market cycle, you get all this accumulation going, and these actually play out on a smaller scale, no matter what you're looking at from a chart chart wise. So whether you're looking at a monthly, a weekly, a daily, you can almost see these types of things playing out in smaller cycles also. But in the larger cycle of things, a lot of people will think that we've already peaked here. That this is in essence done, and this is the representation of this chart, which more fully breaks this out, saying that okay, so this bear trap happened back in 2020. We had this, and then we made our way up, and we had the FOMO and all this, and so we're in essence, the belief is, or what I think is the consensus, people like Gareth Soloway, Christopher Millian, all think we're here, and that we had this little jump up, and we'll take a look at these side by side with the actual market data in a second, and then that we're getting ready for this drop of 20% or so, and so that seems to be the consensus on this. But when I look at this, we have side by side. Now, I've worked with organizations all over the world looking at data, and trying to apply some of the thought process that I have from looking at data to the markets. Now there's certainly differences. I don't deny that. But there's one thing that seems to happen quite a bit is special causes in the markets. And a special cause just means that something unusual has happened that disrupted what maybe normal things would happen. So when I look at this, discovery to deflation, the market cycles here, people are making the argument that this bear trap over here is this. But I don't see the blow off top. So here's my theory. My theory is that because it's a special cause, that this particular event that happened with COVID was just an interruption to the normal increase of things. And so this puts me squarely behind David Hunter's theory that we haven't seen the highs yet. Now, not many people, matter of fact, he may be, there's a few more people following what he said. He's been saying it for a while, and so we have to give him credit for that. But in support of his theory, I think this is a special cause, and that had COVID not happened, obviously this thing would have continued to go up. We would have had a bear market at some point, which is actually where I believe we are now. I think we're in this bear trap right here in the cycle, and that we're trying to make our way out of it. But before we hit, we haven't got the renewed optimism yet, certainly not FOMO at this point in any of the markets, and euphoria. It's just kind of slowly but surely making its way up. And I think that with the pause, this will create the renewed optimism portion here, and then allow more people to get behind it. And it's rightly so. One of the things that David Hunter is all about is what is the psychology of the markets and where things are going. And I think it's at some point, I don't know what it is, it could be the pause, there might be something else, we start to get this push up higher in the markets. And so my belief, my theory is, and again, not a market call, but my expectation is that we are here, that this portion of the market that we are, and this is Dow Jones, we are in this bear trap, came out of it, and now making our way up with a change in the psychology. Now, these are monthly data, and one thing for sure is you're going to have a conversation, because David Hunter gets killed on a daily basis based on hourly 30-minute time charts, the day. He does. I don't believe he looks at any of that, because he always says that, I don't look at any of the, day-to-day ups and downs. So I think this chart would be more relevant to him. And again, special cause here that interrupted this increase. It finished here, that this coincides with this uh, first sentiment extreme where you had some optimism going, and then obviously the Fed came in and moved in. Now, could the Fed be a special cause too? It could be, but they react to things, and I don't see it quite the same as I do something like COVID. The Fed manipulates the markets all the time. COVID, the last time we had an event like that was 1919, and actually that my grandfather died during that epidemic. So the Spanish flu, and then so this is where I think we are. I that's just, it's an opinion. You may have a different one. If you do, please put a comment below and what you think. But I think we're going to potentially get this renewed optimism here, and then we're going to start into the cycle up, and that part of the reason will be because of this Fed pause. So anyway, that's really what I wanted to cover this week. And markets are funny things, but I think you have to have some type of expectation of what you think the future is going to hold. And right now, where I stand is I believe, I have some faith that what's going to happen, it will happen with David Hunter. Now, that we'll get this FOMO and then we'll get this euphoria because we haven't had it yet. And so it's hard for me to grasp without, because I know with those things, having been through a few cycles, I know how depressing it gets, like in 1987 when the market crashed then, and in 2000, and then what transpired from 2008 on, great financial crisis. There's a different feel to it, and I never got that sense of euphoria like I certainly did in 2000, or any sense at this point that we have gone through something like that. So anyway, that I thought I'd share this. I'll probably put this out independently because I think more people getting eyes on it. I'd like to hear different opinions on it. Their expectations are, but that's when I look at data, that's what I see. That COVID really disrupted things. That's what I wanted to cover this week. And remember, there is always a better way.